program will begin in 10 minutes. The program will begin in 10 minutes. Please take your seats. The program will begin in 5 minutes. Please take your seats. The program is about to begin. Please welcome to the stage Bloomberg's Neeraj Patel.
Good afternoon, everyone. Thank you for coming and joining us for Bloomberg's The Future Investor Finding the Opportunities. We appreciate your attendance here, and if you're joining us live in Houston or on the live stream, this is going to be an exciting event and a continuation of our Future Investor Series in 2025. We have a quadrant of corporate leaders with us today covering many different sectors and industries. We're going to have expansive views from telecom, technology, finance, banking, healthcare, retail. So we're looking to get their insight on how they're raising their corporate value, how they're building their competitive advantage, and how they're navigating this era of AI. We hear, hopefully, some stories from them and some lessons to be learned. We're also going to pull in the investor perspective. We're going to find out where they're seeing the next opportunities, what strategies they're deploying, and what is making them the most excited today, whether it's thematic, whether it's trends, whether it's geographic investments. So we're going to pull those two angles today, and we're going to give you full context of the investment landscape. First, we'd like to thank our sponsor, InvescoQQ. Thank you, InvescoQQ. And you will hear more from them later in the program. And our audience here and on the live stream, we want to engage you in this conversation. So if you have any type of question that comes to your mind, please scan the QR code on the table card or on the screen. We'll field your questions throughout the discussion. And we're also going to have platforms available on social media. We have a handle at Bloomberg Live. You can follow us on hashtag Bloomberg, the Future Investor, and you'll see some of the highlights and interactions throughout the day. So with that, let's kick things off. Let's get things started with Tim McLaughlin, QQQ Equity Product Strategist, with opening remarks. Tim.
Good afternoon, everyone. My name is Tim McLaughlin, and I'm the QQQ Equity Product Strategist at Invesco. First and foremost, on behalf of InvescoQQ, our sponsor for today's event, I'd like to thank you all for coming and welcome you here. Would like to also thank our partners at Bloomberg for hosting us today at this event. It's truly a privilege and an honor to work with a true industry leader like Bloomberg. And we at Invesco are extremely grateful for all the hard work that goes on behind the scenes to really bring this type of event to life. I've had an opportunity to travel to a number of these across the country in the last few years, and I always find myself coming away with new insights and perspective as far as innovation in today's marketplace and what we can kind of expect to drive future growth, not only in the markets, but broadly in industry. Without further ado, I'm going to pass it back to Bloomberg. Thank you again for coming here. We'll talk a little bit more about InvescoQQ in a bit, but again, welcome, thank you, and we hope you enjoy the program.
Hi, everyone. Welcome. Thank you for being here, and thank you to our panelists. Thank you so much for taking the time to come and have this conversation. I'm going to give you all a chance to introduce yourselves and tell us a little bit about your day-to-day and your background. So starting with Marie.
Thank you, and thank you for the opportunity to be here. My name is Marie Myers. I'm the CFO of Hewlett Packard Enterprise. We're based in Houston, Texas. We serve, hopefully, many of you in the room. We are in the business of networking, data center provisioning, and storage. And as you can tell, this is not a native Texan accent. I'm originally from Australia and delighted, looking forward to the conversation today.
Kevin.
Hi, I'm Kevin Mitchell, CFO for Phillips 66. We are an integrated downstream energy company, also headquartered in Houston. By downstream, that means we do not produce hydrocarbons. We have no drilling activity or oil reserves, but we do take those hydrocarbons and turn them into more valuable products that are essential for everyday life. So everything from transportation fuels to lubricants for industries to plastics that go in all manner of different products. So very happy to be here. I also am not from the Houston area. I come from the northeast of Scotland, but I've been here for a long time and I consider it home.
And Marie.
Cheryl Karen, and I am with Jones Lang LaSalle. We are a global corporate real estate company. We focus on investors and serving occupiers all over the world. We are globally headquartered in Chicago, so I too am not a native of Houston. And we also provide global technology solutions for our clients, fundamentally changing the way work is delivered, managed, and created. So.
Apologies, Cheryl.
That's okay.
We spoke so many times and just had a brain mix up there. But welcome. Thank you. Thank you again for having this. I'd like to start off with a question for Kevin. Can you walk us through the recent deal that Phillips announced with Kinder Morgan for the companies to build a new pipeline system and reverse the flow of some of their existing pipelines to transport gasoline and fuels to California and western states?
Yeah, absolutely. I'd like to take a couple of minutes to do that. So in conjunction with Kinder Morgan, we announced a potential project to essentially move refined products from the middle of the country, the sort of mid-continent area, out all the way to the west to serve markets in Arizona, Nevada, and California. And to those not in the energy business, it might not seem like a big deal, but we've actually never had the ability to transport fuels west in that manner. We're a large refiner in the mid-continent. It's one of our core operating areas. We have some of our strongest assets there, and we're very deeply integrated through our marketing network as well. But the ability to also have another market to move product into, and that's a market that you may have seen that there have been announcements of refinery closures, including one of ours. Our Los Angeles refinery is idling as we speak right now because of challenging market conditions. It's a asset that no longer competes as well as it used to. It's a difficult place to operate those kind of assets, but there is still demand for fuels in that market. It's a very big market. And so the ability to offer that service of energy products into those markets, we think could be a potential game changer for companies like ours who have significant refining in the middle of the country, and to provide that additional optionality to cost effectively provide energy out into those markets. Now, just for clarity, we've announced an open season, which means companies are submitting bids to potentially ship on the pipeline, and that will determine whether the project ultimately goes ahead. And so it's a combination of new build pipe plus changing directional flows of other existing assets that both Kinder Morgan have and we have, combined with some new build pipeline. So very interesting project. The initial indications have been positive, but there's a way to go on this.
Okay. Yeah, it is going to be an interesting project because it's interstate, and I have a follow-up question for that. It's like, what type of support are you getting from Washington because it's crossing multiple states and there's permitting issues?
Yeah, so permitting is always a challenge in our business, and right now the federal government is somewhat friendly to the types of projects we would like to do, but it's not just about the federal government. We've got states and counties and municipalities to work with, and so we'll have to navigate all of that. We feel pretty confident that the sort of route that we have chosen, that we can get this done, but there's a lot of work to be done to get there. I will say, though, just high level, the federal government is very supportive of this project. They're very much about domestic energy supplies for the country, for the benefit of the country. And if we can have alternative sources of fuel supply into those Western markets, then that's a good thing for the economy as a whole.
Any cost estimates?
Not yet.
Okay. All right. Had to ask.
Yeah. You're not the first.
Well, since we're talking about deals, this question is for Marie. HP acquired Juniper Networks in July as part of an expansion. What factors specifically made that purchase really attractive, especially when weighed against the backdrop of volatility and uncertainty in today's market?
Yeah, no, I think it's a great question. And, I would say I'll just walk you through why we did this transaction. I mean, we've been in the business of, really providing infrastructure that's critical for companies as they're really embarking on the AI journey. And I would say there's clearly, a lot of infrastructure investment going on. I think you can't help but sort of read every day of a new deal that's been locked up. Probably what's least understood as you get into the data center and into all the infrastructure requirements is the importance of the network. We did have an existing networking business, but we hadn't really scaled that business into the data center more holistically. So the acquisition of Juniper really gave us an opportunity to get the full stack in the networking space. So we cover everything today all the way from what it's called campus and branch through to sort of the SASE security space. And now we've got a really good toehold into the data center, which as you start to deploy AI infrastructure, being able to really get the highest level of performance from those GPUs is absolutely critical. And so what's probably not understood too well is just how critical it is to have that network running all the time. And Juniper has an amazing capability that we didn't have to actually sort of integrate that capability now into our portfolio. So one, I think the time is right. Sometimes with these deals, you look back and say, hey, did we get it right? And I would say, the timing on this deal is probably perfect in the sense that we're still in the early days of enterprises really adopting AI. We've seen the infrastructure build up, but we're still at a fairly nascent stage for companies to really expand their own infrastructure and really embrace AI much more aggressively inside companies. So I think that the timing is great. And secondly, it puts us in a really unique position. There's just no other company in our competitive space that has the full stack portfolio. So we're using this deal to transform our company into an AI-led networking company. And then finally, honestly, the margins out of networking are fundamentally incredibly attractive. So we shift really almost 50% of the operating profit of the company into networking. So a really compelling transaction.
Right. I want to bring Cheryl in here. Marie talked about networking and data centers, and we all know that the AI boom is driving a lot of investment and development.
Yeah.
So what are you seeing at the intersection of tech and commercial real estate in those sectors? And is your company using AI for operational efficiencies or even to manage buildings?
Absolutely. So I'll take that from a number of directions. We serve the tech industry as one of our core industries that represent a significant client set for us throughout the life cycle of our business. Everything from capital markets to our outsourcing business. And we also have a separate data center business. And the sort of intersection that we're seeing between everything from the investments that we're seeing our tech clients are making, that we are seeing in terms of space requirements, energy demand for data centers, just the load requirements, the lack of available space that there is out there for data centers, and the flight and the flee to the quality of data center space and different parts of not only the United States, but parts of the world that are getting those companies to go there is driving tremendous activity in the world of real estate. But also from our standpoint, from a delivery mechanism to occupiers, we are utilizing and leveraging AI more and more every day. I think the crux of the issue that we have is how do we get our people to adapt and to rewrite processes, to be able to move at the speed that these tech and data center companies are going. And then on top of that, there's a talent piece to this that can't be really underscored enough. Data center talent is vital, critical. If you blink, you'll miss an opportunity to get a very limited pool of people that know how to operate these data centers. So, and then there's the added measure of standard building technicians and operators and engineers who have operated in legacy type buildings that are now going into these ultra high tech AI driven facilities, and their ability to learn, to adapt, and for us to have a workforce that is ready now to be able to operate these facilities as they're coming online is another aspect. So it's almost like an end-to-end problem that we're trying to solve, everything from just sourcing the land all the way to sourcing the talent to deliver.
Staying with real estate for a little bit, but I want to talk about policy changes.
Sure.
You and I spoke about the H-1B visa restrictions.
Yes.
Can you talk about how policy shifts like that play out in the real estate sector and how they stand to affect global companies in choosing where they choose to invest in physical spaces?
Yeah, sure. Well, what we are seeing is that policy changes have a pretty significant effect on real estate. Sometimes it can be to the benefit, and sometimes it's to the detriment. It depends on what it is and where it's happening, and how either the investors or the occupiers are going to respond to that. The HB1 visa challenge that we have now is we're seeing for clients across healthcare, across technology sectors in particular, are the ones that are reacting quite significantly to them, and are probably the ones that will be the most impacted. There are other indicators. Organizations like Walmart, for example, are pivoting away from HB1 visas, and they will be changing their talent strategies. What we're hearing from our tech clients, and perhaps Marie could attest to this, is in certain ways it might provide some sort of benefit, because there will be fewer entrants or fewer petitions for the HB1 visa, simply because it will be cost prohibitive for many organizations that don't have the big checkbooks to be able to write checks to do this. So there will be fewer petitions, which could be an advantage for tech companies, so that they can hire the top talent that they're typically seeking, which may be in another country. But on the flip side, we're seeing many of our tech clients pivot away from the visa altogether, and they're saying, we're just going to change our talent strategy. We're going to place our top talent in other places, which could be a detriment to the real estate market, because that means if they're moving their innovation centers, if they're moving perhaps their headquarters in some regard, or major locations that house this top talent to another country, that means we have a little bit of a problem in terms of the real estate market and the stagnation that could occur from that, and the lack of innovation.
Right.
So,
right. I want to talk a little bit more about policy, but shifting to energy and energy transition. So I'm looking at you, Kevin. Mm-hmm. Phillips has made a lot of big investments and some divestments in California, like converting the Rodeo refinery to renewable fuels. But then policy shifted around the credit incentives. And this quarter, as you mentioned earlier, you're going to be closing the Los Angeles refinery altogether. So needless to say, the energy transition in California is complicated. Would that be right? Is this how you expect it to play out in other markets too?
It's certainly complicated. The challenge with the Rodeo facility, which we did that conversion about 2 years ago, we completed the conversion. So no more crude oil processing. It's all renewable feedstocks. So think about bean oil, used cooking oil, fats, greases, tallow, and the primary products are renewable diesel, which is the same as carb diesel from a molecular standpoint, just comes from a different feedstock, or sustainable aviation fuel, so similar to jet fuel effectively. When we initially brought that project online, we had significant credit incentives on manufacturing and selling those renewable fuels. They're necessary because the feedstock costs more than the oil-based equivalent fuel sells for. So your starting point is it costs you $150 per barrel for the feedstock, and the end product is worth $70. So that is not a proposition to go into business on. But we were receiving significant credits, and there are several different components of those different credits that actually made up that difference and more, to where this could actually be a very attractive business to be in. But with some changes over the course of this year, last year and this year, a lot of those credits have fallen away or no longer have the same eligibility. And the easiest example here is the most attractive feedstocks are the imported, we call them low carbon intensity feedstocks, so used cooking oil, fats, greases. So it's products that have already been used. They're some form of waste traditionally, but you can then process them and make more valuable products. That feedstock is imported because that's the primary source of those feedstocks, are Asia. They now attract a tariff on import. A competitor making renewable diesel in Singapore can bring that product into the West Coast and not pay any tariff. So we're disadvantaged right from the beginning with our feedstock is being tariffed. We don't have the same credit generation that we used to have, and so that facility is under a lot of financial pressure. So we're doing all the things you would expect to do in terms of what can we control, where can we reduce costs, how can we alter our feedstock slate. If we use domestic feedstocks, then we're less disadvantaged. There just aren't the same availability of feedstocks. And we're also, the irony here is we're finding better economics to take in those products, both renewable diesel and sustainable aviation fuel, from the West Coast and then shipping them around to Europe, to markets in Europe where they have very attractive incentives for those fuels. And that's our priority now. And so instead of this being all about sort of energy for America, we're actually making energy and shipping it to other markets that are more attractive from an economic standpoint. Still not where we need to be. Just to be clear, I mean, there's a scenario where this facility does not make it. I mean, that is a sort of worst case. It's not our base case. It's not what we want. And we're pursuing all avenues to make this a successful business. But it is definitely challenged.
We have a question that's coming in online right along those lines, asking if any policy reform in California would make Phillips reverse and change their mind on closing the Carson refinery.
Yeah, really not. I mean, our Los Angeles refining system is two sites, Wilmington and Carson, and they are connected in refining configuration by pipelines about 5 miles apart. Both facilities are in the final stages of shutdown. So we introduced our last crude oil into the Wilmington facility in the middle of October. And so now we're just running off the intermediate products and in the process of disposing of all of the remaining products and starting that complete idling process. One of the challenges that asset had is the oldest refinery in our portfolio. It dates back to the late 1800s. It was built to consume California crude oil. And back in the heyday of California crude production, that crude oil was very attractive and attractively priced, strong economics around that. But because the state has made it so punitive on the upstream sector to develop and produce, production is down to something like a third of what it was just 20 years ago or so. And so now all the refiners are competing for that limited supply of crude. So you've lost that crude feedstock advantage. that you used to have, and you combine that with its expensive place to do business, the regulatory requirements, just the underlying cost of operating those facilities, the energy cost, made it non-economic for us to continue. Yeah. And the location, we have 650 acres in total, very close to Port of Los Angeles, Port of Long Beach. There's a lot of alternative use value options that we can avail ourselves of.
You mentioned tariffs, and that segues right into, I wanted to ask some questions on tariffs about HP's strategies, Marie. So HP is adjusting to using manufacturing facilities outside of China for North American products. What's the company's outlooks on tariffs in the AI era, especially when it comes to high chip costs?
You know, I'd have to say that I think that volatility is sort of like the new baseline. I think we all have to plan today for things to be not stable like they were a few years ago. And, you know, we've been fortunate enough, we're a global company, we have a footprint in, you know, all the main geographies in the world and hundreds of countries. And so over the course of our 80-year history, we've been fortunate enough to build up manufacturing operations in lots of different geographical locations. So you need to build that resilience all the way through your supply chain. And that's something I think we've demonstrated over the years we've been able to do, and we'll continue to sort of avail ourselves of that strategy. And, you know, it's just critical. I think a company today has to, you know, run multiple scenarios and has to be prepared for what is going to be, I think, an increasingly more volatile world than we've perhaps been accustomed to in the last decade.
Right, right. We're getting close to time here, so as we wrap up, I want to give each of you a chance to give sort of a policy wish list. Well, I know you have one. What would be the top item on your policy wish list in your respective industries? Either a change or... I'll start with Cheryl.
I'm not sure that there is a policy that is so egregious that I have a wish list for it, but I would just go back to something that Marie said. One of the things that has created a lot of challenge and in some ways inertia in real estate and makes it difficult to predict you know, where your next move is the lack of you know, more of a stable base to work from. It's so volatile, and every day you wake up, there's a new threat or there's a new challenge that comes up, and sometimes that's impacted by a policy change, but sometimes it's other factors. And so, you know, if I really had a wish or some sort of influence on something, it would be that we get a little bit more stability, because we're going to need that as we're facing something like AI, which is going to disrupt our industry pretty significantly and that of our clients. And we need to be focused and be very deliberate and get people on board to make those changes. So,
how about you, Kevin, in energy?
I would say a policy around renewable fuels and renewable feedstocks that does not disincentivize U.S. companies, U.S. manufacturing, because that's the situation we're in now. So that's one very specific request or ask. The other would be not dissimilar, just consistency. Fundamentally, we can deal with most policies if we know we have consistency, and then we can plan around them and make our decisions accordingly. And that's an important thing, even if we don't particularly like them. But if we have consistency around it, we can usually do okay.
I think I've got the easiest question to answer now. So, look, I think we've all been dealing with a lot of general macro uncertainty, policy changes. I think my big wish going into 26 is exactly what you both said. I think we see a much more stable environment. I think most of us been in business long enough, we can manage through changes, but certainly there's been a lot to take in, and the timing of all of that has been somewhat unpredictable. So my big wish for 26 is we see, generally more stability in policies and also, a more stable sort of international macroeconomic environment.
Well, that's time for us. Thank you all so much for taking the time.
Thank
out.
you.
Thank you.
Appreciate it. Thank you.
Good afternoon, everyone. My name is Alexis Maxwell. I'm an equity analyst with Bloomberg Intelligence, and I'm delighted to have Tim McLaughlin back up with us on stage. A couple of questions here as we transition into our next session. So, Tim, as a quick reminder, can you tell us what InvescoQQ is?
Sure. InvescoQQ is an ETF which tracks the NASDAQ 100 index. So the NASDAQ 100 index and by effect the QQQ are comprised of the largest 100 non-financial companies listed on the NASDAQ stock exchange. So we think the resulting exposure is something that gives you access in a single ticker solution to some of the largest and most innovative companies in the world. By way of AUM, or assets under management, QQQ at roughly 413, I think I saw last close, $413 billion, is the 5th largest ETF globally. It's also the second most actively traded ETF in the world. It boasts a 26-plus year track record, so it's one of the oldest ETFs on the street. And I think in a way it's kind of innovative in itself, based on just that long track record and really launching in the nascent stages of the ETF industry.
Thanks, Tim. With that track record, then, in today's rapidly changing economy, how are the holdings within QQQ adapting and evolving to keep pace with current trends?
So, we talk a lot about innovation in the context of InvescoQQ. And one of the things that comes up is like, well, how do you quantify that? And how we like to quantify it at Invesco is through research and development, or R&D. And if you look at the weighted average spend from a research and development standpoint of a QQQ company versus something like the S&P 500, similar stack up, right? The weighted average spend from an R&D standpoint of those companies, what you see is a significantly higher spend for QQQ companies. So I think it's as of the end of last year, the average was $17.7 billion for a QQQ company versus roughly $12.7 for an S&P 500 company. So you have a 1.4x multiple above that of the S&P 500 if you look at it from an R&D standpoint, and that's pure dollar. But if the thing is, as the Qs have grown and as tech has obviously gone on a significant run in the past decade plus, what you see is a growing proportion of companies that are sitting within QQQ that are now represented within the S&P 500. So it's roughly 85 companies or so that are in both indexes. And if you were to strip out those companies, those 85 or so from the S&P 500 and look at the R&D of the S&P X Qs companies, what you see is that drops significantly and that multiple jumps up dramatically. I think the R&D on the S&P 500 goes down to something like $1.4 billion as far as average spend. So we like to think of innovation again in the context of that R&D, and really just kind of it's ingrained. The commonality we see across Qs companies is the commitment to reinvest in themselves and really drive things forward. And you can't innovate, you can't stay ahead of the curve without investing. I think a lot of these companies we've seen have also, they look a lot different than they did, from even 5, 10, 20 years ago, right? Amazon being an example, started off as an online book retailer, and now it's, a hyperscaler as far as the AI data center is concerned. Obviously with a huge retailing business as well, but these are companies that are nimble and have been able to diversify their core business segments.
Thank you. One last question then. When it comes to investing in emerging technologies, where is QQQ shining outside of the technology sector?
Yeah, so one of the biggest misconceptions we come across as far as QQQ is concerned is that it's a tech fund, right? If tech is up, Qs are up. And there's definitely truth in that because it is tech heavy. If you look at an ICB classification standpoint, it's roughly 64% of the portfolio is within technology. If you look GICS, it's somewhere around 55. But you do have a significant portion of the portfolio that really falls outside of technology. And I think what we've seen in this day and age, right, is there's a lot of intersection across industry, right, where you have pure technology companies, but you have a lot of companies that are not pure technology companies that are really tech-centric in a lot of different ways. So we've worked with NASDAQ, our index provider, to provide some research around patent filings of the QQQ companies. And what we've seen across roughly 30 disruptive areas of technology is that you have significant representation of Q's companies over the last year filing patents in those areas. And you see the ones that are associated typically with AI, right? Natural language processing, big data, even cybersecurity. But what you do see is differentiated exposure in sectors like healthcare, right? So filings in robotic surgery, nanorobotics, bioinformatics. You also see things like nuclear power, nuclear energy come into the fold and representation there. So we think that QQQ really is a good solution as far as a core holding and a diversified portfolio as far as large cap growth is concerned, or even a satellite holding if you're trying to get exposure to some of these companies that are driving innovation. And I think the fundamentals have really supported kind of the mentality around R&D and driving that innovation forward when you've seen significant growth rates on a 10-year CAGR standpoint. Both sales and earnings are significantly higher for QQQ than they are compared to not only the S&P 500, but Russell 1000 growth.
Well, Tim, thank you for your time and support for the event today. That's all the time we have. Thank you.
Thank you, Alexis.
We have Vikram Taneja. He's head of AT&T Ventures today. We're going to dive into the topic of strategic investing. And before we dive into that topic, Vikram, maybe you can give our audience a little bit of context on your background and your experience at AT&T.
Yeah, happy to, and happy to be here. I've been with AT&T about 11 years. A lot of that was in sort of the corporate development tree. That was media and sports-related M&A, kind of when we had a broader sort of base of assets. We've always had a pretty strong investment portfolio. I'd say in the last 3 or 4 years, we've started to hone that in and kind of corral it and relaunch AT&T Ventures. So that's what I've been up to the last couple of years. Prior to that, the time with AT&T was various startups, a little bit of time in investment banking and venture capital, and so it kind of all came together over the last decade or so at AT&T.
And just to get a little bit of framework, how does AT&T differ in its corporate venture activities versus traditional venture capital and other corporate VCs?
Yeah, it's a good question, and there's probably a couple different distinctions, and maybe the first one I'll make is between corporate VCs and traditional VCs. So you think your Sequoias, Andreessen's, that type of firm versus corporates. There's just inherently there's going to be more strategic focus on what the corporation is looking for when they make an investment. They may have some financial goals, but in all likelihood, they're looking more for strategic insights, things that are related to their business. Maybe they can advance product roadmaps. Maybe they're looking for new types of innovation in that category. So that will always play a part of the rationale between the two. I think what you'll see a lot of times with corporates and traditional VCs that there's sometimes complexity and deal structures. Maybe a corporate has to, they can't do safes, but they can do convertible notes. Maybe they won't lead rounds, or they won't go over certain valuation thresholds, whereas there tends to be a lot more flexibility on the traditional side. So as I think about it and how we position our venture product, if you will, it's that we aim to be very founder-friendly. We originated out of sort of an M&A mindset, so deal structures are not something we shy away from. We're happy to kind of engage in different types of equity offerings, recaps, bridge rounds, things like that. We're very comfortable with that. We also don't, when we're sort of leading around or in the middle of a deal, we don't do what a lot of corporates may do where you'll have sort of, I'll call them exotic terms. Maybe there's ROFRs or MFNs, things like that that are in some ways punitive to startups because they're just trying to get going, and restricting their business in certain ways can be a challenge for them to overcome. So we made a conscious effort when we started this again was that, we need to go in almost advocating for the founder in a lot of ways. And so that's kind of a unique part of my role, is that I feel like I'm advocating for the portfolio companies inside of AT&T, but it ends up being a win-win because the company, the startup succeeds, and the benefit we're looking for from a strategic standpoint has a better chance of payoff.
And to dive in, maybe where are the areas you're prioritizing today? What is at the top of your list?
Yeah, it's a good question, and so we sort of look at the landscape when we look at what are areas we want to invest in as sort of does it make our network better, faster, more secure? That's going to be things like edge compute, cybersecurity, different types of AI, radio technologies. Or does it drive demand onto our network, right? So whether it's wireless or fiber, for 15 plus years, the primary driver has been smartphones, right? And we're past that cycle. AI brings a lot of new exciting categories into it, whether XR finally takes off or whether there's pull through from autonomous vehicles or robotics or new rulings with drones that'll allow more teleoperation. All of these are new categories that make me excited, but these are all kind of in this new realm of demand drivers for connectivity for us.
And among the many variety of technology trends today, and this telecom heritage of AT&T, how much do you have to keep oriented towards telecom, and how much can you venture out to other new technologies who are quite immature at this point?
Yeah. We will, it's kind of a mix, right? There's definitely a focus, and our network team is great and always kind of looking for new technologies to make routing more efficient, make our spectrum usage more efficient, or power consumption more efficient. So we're happy to invest in those technologies, but then kind of these more greenfield areas, right? Humanoid robots, like I've been looking at that a lot. We think that's a huge connectivity driver, and we're decades away, maybe not, depending on some of the recent announcements. But those are exciting, and we don't necessarily have a product roadmap to hit those categories right now, but we know that there's a need for connectivity, and it's something that we'll sort of evolve into, and so we'll place those bets also. We're happy to do that.
So when you mentioned humanoids, trigger of other new tech, IoT, 6G, which technology today would you say is the most overhyped, and which one is underappreciated?
Overhyped and underappreciated. I think I may put the broader bucket of physical AI, which I would have put robotics in there, as underappreciated. I think you get a lot of agentic AI. Maybe that goes in the overhyped, frankly, just the way that it's thrown around so much now. AI is real. Agentic AI will be real as it's implemented. But I think what a lot of people don't see yet is the next layer of this is how it influences your physical world, right? Whether that's autonomous driving, whether it's robots that are doing tasks around, whether it's drones that are delivering, food deliveries or packages. This is all starting to be available now. And I think one thing, as we think about even the network load, one of the reasons it's interesting to us is because when 5G was developed, it was with a lot of this in mind. And so you started to have networks start to emerge that didn't really have these use cases. It was just, can I stream my YouTube video, right? You could do that on 4G, but as you have more denser and more disparate, even in some ways, need for connections and connectivity, you start to see the demand for that next-gen network start to emerge. So those are probably what I would say for those.
And you describe being AT&T Ventures being very founder-friendly. Mm-hmm. What are some of the criteria for a startup? Is there some non-negotiable terms in order to be part of your portfolio?
Yeah, I think there's always sort of the filter of does it hit, does it make the network better or drive demand? So we'll always look at that. In terms of size and stage, we tend to be in kind of a Series A, B timeframe when we make our first check. We'll go earlier or later, just depending on where we're at. We have some flexibility around that, so it's not a hard requirement. I think more than anything, as we start to do diligence and see, hey, do we have some kind of path to commercialization, or it's on a roadmap somewhere, as that starts to crystallize, we try to get to know the management team. I'm always interested in getting to know the founders, understanding what their passion is, why they're looking at this particular problem. And the more companies that we meet, you just realize how much they sacrifice of their personal life to get this company off the ground, whether it's time or relationships or energy or capital. It's just, there's got to be something bigger than I want to build this widget. It's got to be something behind that. So it's just a lot of time that we spend with the management team to understand kind of, is this the right group of people to get this company to some kind of an outcome? And so if we feel good about that, that's probably the gating item, right? Like, if we do, then we would potentially think about the rest of the things to invest. If not, then maybe it's not the right fit.
Okay, and in writing a check, there's a risk-reward kind of association with it. Mm-hmm. What is your metrics for determining success or not so successful investments?
Yeah, and some corporates will differ, and this is even an area going back to the traditional VC versus corporate VC area. Coming in at a Series A, B, usually there's some kind of product in market, there's some degree of fit, maybe there's revenue, maybe there's not, but you're de-risked from the very early seed stage investment where this company may not go anywhere. So we probably take fewer zeros in that sense, right? We're not deploying just at the seed stage. We're deploying dominantly in that A, B, C area. We'll take a few seed bets where they're really, strategically important and see where those materialize. And so that affects the financial, performance of what we look at in the metrics. So we're not trying to 10x every investment. Number one, we're looking for strategic insights. We're investing in categories where there's a product that we really like. It's in a category that we want to have more exposure to, and we want to either work with them on distribution or packaging our own solution in market, and then see where things kind of go from there. So that tends to be, further up the risk curve, but it's something that we feel comfortable with at that point.
So there is not a fixed revenue level or customer count?
No. There are, I'm even thinking of the portfolio right now, we've got investments that are sort of the three guys in a garage type of situation where they've just got great tech, have no plan to commercialize it, but we know that it's really good tech and want to help them with that. We have others, like Databricks, right? They don't need us for anything on the investment side. They're doing great. And so you kind of have the spectrum of it. But like I said, usually they're in a kind of 10 to 20 million revenue, and they're looking for trying to scale the business.
We have a question from the audience here. And any thoughts on accelerated computing AI? And will it impact the development of future networking technologies, i.e. 6G?
It's a good question. This sort of computing or compute in the network is something that we think about a lot. And there's all kinds of companies, CoreWeave, Grok, Cerebras, that kind of bring this capability. And you think about, can you deploy this into an edge node and put that level of compute, like a GPU in the network, so that you can utilize it? Now, I'd say the use case needs to be there for you to just go to GPT on your phone and send a query up into the cloud and get a response. That's probably sufficient. So what are the use cases then that are high bandwidth and super low latency? Low latency is sort of the marker of why you would need edge compute or GPUs at the edge. So now you're talking about use cases like autonomous driving. If I'm doing a lane change, I don't have time to go to AWS and come back. You need something faster. If I'm doing robotic surgery, right, remote patient monitoring, healthcare-related use cases, you need much more visibility and speed in your decision making. And it's why in some cases, then there's like the third category is just on-device compute, right? Is it so fast, the need is so fast that I just need to do the processing and have the GPU in the device? Maybe, just depends on what the use case is. So I do think that now that we've moved past just smartphone world and you're starting to see more requirements, inference for AI in different applications is very compute heavy. And so those are the types of things that'll drive it. I do think that that's going to be a component of future networks, whether it's with 6G or 5G, frankly. I mean, you can do it with the existing infrastructure of the network at the radio level with new compute kind of around the edge. So it's how do you think about that? But I think that all these use cases are starting to emerge now. So kind of excited to see where that all goes.
And zooming out a little bit, maybe you can provide the audience a little bit of context on how hard or competitive it is for corporate VCs to go after the top tier investments. There seems in the public markets a significant concentration in technology investments.
Yeah.
Is that happening in the startup, in the private area, or are you seeing a broadening out?
There's definitely, I mean, venture is sort of known for signaling and club deals, right? It's, the markers of success, even before I was at AT&T at a smaller shop, you'd see, Kleiner Perkins would lead an A round, and that was good for them to raise through their Series C, because just because people saw them in the A, they would go and invest in them in the B or the C, and you'd kind of see where things go. So, I mean, the company still has to perform, but access to capital becomes easier. And what's happened over the last, call it 10, 15 years is the mega funds have started diversifying so much that, Andreessen, Sequoia, NEA, they all have sort of seed and scout funds. So they're deploying capital very early, picking their winners and then just doubling down over time. So it does leave that not that much allocation available for others to come in. And so the fortunate thing for us is that we're not fighting with the non-mega funds for access to deals, right? If there's deals that are in the connectivity space, we're probably going to get asked or welcomed into those rounds. So it does make that easier in that if there's a company we were talking about earlier that was modernizing 911 infrastructure, sort of a cloud-native call handling platform for 911 centers that makes it much easier for when you call 911, you can enable your camera and pass that feed to first responders if you're in sort of a fire or something like that. And we like that category, but more importantly, that's something that we worked through our FirstNet teams with 911 centers. We knew that as this company was raising capital and we started to get interested in them, we would be able to have productive dialogue and add value as a corporate. So that makes it easier to get into those deals. I do think that kind of that middle level can get squeezed out at times and make it harder to get access, because now when you have a winner, everybody's taking their pro rata, if not more, and so there's just not enough available for others.
You've been head of AT&T Ventures for several years. Mm-hmm. What has been your impact in terms of driving this organization?
I think, we had a very large investment portfolio that was sort of disparate, I think was one thing. We had a legacy of just accumulation of investments and sort of organizing all of that, harvesting the ones that we knew we wanted to kind of make our core portfolio and positioning it for being back out in market as AT&T Ventures as a bit more branded than we had been in the past was important. We track deals that are happening kind of globally in our ecosystem and see who's doing what and are they interesting or not. And I think one measure of success that we have is really just the top of the funnel. Are we seeing everything? Are we getting access to all the right deals? And the last couple of years, our hit rate's been very good on that. We've at least seen all of them. Whether we've done them or not is different. But that's been a big piece. It's just kind of getting back out there with this sort of dedicated effort. And then one thing that I think we're getting better at and working through is just sort of exposing this idea around innovation through startups internally into the company. One thing we've really benefited from, our product teams are very smart. They have great, biz dev folks and strategy folks that are kind of on the front lines of their respective industries. They see interesting companies, and they may have already been working with all of them and doing commercial deals with them and bringing them in, but we weren't necessarily sort of investing in them, right? They weren't being surfaced up to ventures to look at, evaluate for additional upside or additional opportunities where we can kind of take those relationships and move them into other product teams. And so we've done a better job of that, I think, internal to the company, of kind of raising that awareness and saying, hey, we welcome this type of innovation. We want to see more of these opportunities. And I think that's something that we'll continue to focus on, right? Just kind of driving home that point kind of with our respective product partners.
We're going to wrap up here on time. Just leave the audience maybe with your outlook on corporate VC investing. What do you see over the next 5 years? Okay.
I think, I forget around the time frame that we started to see it, maybe in sort of pre-pandemic, we started to see more corporates participate, right? And we track this stuff, so we look at it. I think the data is something like roughly a quarter of every venture deal that gets done has a corporate venture firm participating in it. That's pretty high compared to the 2000s. So I think what a lot of corporations realized is they get access to deals, they see revenue opportunities, we get really good technical and product diligence from our own teams. And so if you're able to find a way to bake that into your return profile and say, hey, a relationship with this company can really drive a lot of value, we should also participate in a round and try to catalyze their own growth because it's going to help both parties. I think most corporations have kind of become privy to that. They've realized that. And so there's not very many large Fortune 500s that don't have some degree of venture investing program, and I don't think that's going away. I think that'll continue to accelerate just because of the amount of data and insights you get from working with these companies day to day. It's I like to call it free diligence from our engineering team all the time, right? I rely on what they see. I rely on their insights in those respective industries. And then we kind of layer on our own investment analysis and make a decision based on that. I think it works out really well, and I think you're going to see that continue to grow.
Great. Thank you for the conversation.
Thank you. Appreciate it.
We've saved the best for the last, so guys, gear up and cheer up. By the way, if you've not realized, we're almost at the end of the year, believe it or not. And what a year has it been, right? Well, markets have stayed surprisingly resilient with the tech and the AI-driven themes and large cap US names doing bulk of the heavy lifting. But beneath the surface, so much change, so much uncertainty, right? Be it sticky inflation, choppy liquidity, and now a Fed that's signaling patience, while all of us are hoping for a rate cut in December, correct?
Yes.
Absolutely. So the new administration is shaking up fiscal priorities, energy policy is back in headlines, and we have an AI trade that feels a little too hot to touch. So we have a lot to unpack, and I have the absolute best panel right now and my amazing panelists to help us do that. So please join me in welcoming Eric, Kara, and Stephen. But
that was kind of lukewarm. I don't know.
Okay, let me take care of that. We're going to start with the macro front, but We want everyone to participate in this now. So let's start with the macro picture, and I want to see a show of hands. How many of you believe that interest rates will be 100 basis points lower by the same time next year? Wow. How many of you think it's somewhere between, they will be lower, not 100 basis points, but lower? Okay, so there is some conviction around that. Eric, let's start with you. We had a long chat about this. 2 years of inflation uncertainty, rates volatility. What is the landscape looking like, and what is the most underappreciated risk that you think in this macro backdrop?
Well, it's great to be here in Houston, and certainly a pleasure to spend some time with this group. So we think the biggest risk is what we call an edgeless risk. When I say edgeless risk, meaning it's very difficult to forecast. We all have tools and resources we use to predict and obviously try to extrapolate what may happen. But I think the biggest edgeless risk out there is that the world becomes even more isolated more quickly, meaning the world is becoming really far adrift from the traditional trading blocks we've had for a long, long period of time. It's more transactional, more country by country, deal by deal, and that, let's call it repatriation of the world order, is a risk that I think is probably discussed, but the rate at which things happen is probably underappreciated. The last thing I'll say is this. It's a great quote in the book, The Sun Also Rises, which one character is asked, how did you become bankrupt? And he said, suddenly, but then all at once. I should say gradually, but then all at once. My English teacher's kicking me for missing that line. But the idea that this world order could actually kind of go drip by drip, but then change quite rapidly, that for us is probably the most underappreciated risk out there.
So are you thinking that we're entering in a world where growth and inflation both remain high for a while?
We do. I think that, we're approaching Thanksgiving. We think inflation is kind of like your in-laws that hang out the sort of Saturday, Sunday, maybe even the Monday after Thanksgiving, and it's like I still love them. I just maybe love them a little bit less. U.S. inflation projected at north of, let's call it 2.8, 2.9% through the middle part of next year. That's a very, very high rate relative to rest of world clocking in somewhere around 2. So we do think the glass is half full for growth. We actually think inflation, though, is probably hanging around a bit like the in-laws longer than we'd all like them to be.
I didn't say that. That was him. Kara, what's your read on the macro? And especially like from a portfolio construction lens, are you still defensive, or are you leaning a little bit more on the offense now?
Yeah, it's hard to believe, but we actually are pretty offensive right now. And if you think back to where we were earlier in this year, we talked about the first half of the year as being like the Rumpelstiltskin market, where if you'd gone to bed January 1st and then woken up in the middle of the year, you would have been like, I did pretty well. But of course, those of us who were awake for April knew how the depths of despair, right, from tariffs. But then even more remarkable, the second half of this year has really picked up steam. But we think it's not just running on vapors, right? When we look at corporate earnings power, it's really come back from those depths in the second quarter. We're in the middle of earnings season right now, and it could be shaping up to be the best earnings season in a couple of years. The Fed is much more accommodative. We also agree that inflation is going to remain sticky, but we think that the Fed's going to accept that and say 3% is okay. We've survived like this for long periods of time. And with that, they'll be able to continue to be somewhat more accommodative. So that becomes a really nice backdrop for risk assets. How we're putting on that risk is a little bit different today than where we were a year ago, but in general, we think it makes sense to lean into the market here.
Got it. So risk on for Kara. So David Solomon said yesterday that there's a tremendous backlog of large M&A going into 2026, 27. Stephen, is that true for the energy sector? And you speak with a lot of CEOs and CFOs. How are they positioning? Are they positioning for growth, or are they being a little more cautious right now?
I think you can bisect the sector a little bit. First of all, I wouldn't say there's a large backlog of M&A activity, because we have gone through a series of multiple years of pretty substantial backlog. 24 saw a lot of big transactions happen. 25, we're seeing a lot in terms of numbers of transactions, but they're smaller. So, the Conocos and the Oxys and the Exxons, now Chevron got their deal done. The big cap companies in the energy sector have gotten deals done. Now we're seeing a lot of small consolidation. We saw a deal announced yesterday between Civitas and SM. So we're still seeing these deals. That doesn't spark another deal. the investor universe today wants to see fewer, larger, stronger companies with strong balance sheets. So that is going to force consolidation. When you ask about are these CEOs, CFOs poised for growth, I'd say the bifurcation, I would say, is on the oil side, much more cautious. We obviously have an administration right now that wants to see oil prices lower. I just came back from the Middle East, and I can tell you lower oil prices is not what they want. They are cutting back on some of their CapEx. I think they seem to be accommodative to our current administration for a period of time. I don't think that's going to be remain because they do have social costs, a break-even cost in the oil of somewhere between $80 and $85. I think they're very comfortable kind of in the $75 area. So I think while they're being accommodative today, I don't think that's going to remain. So oil, while being much more cautious today, and we see rigs coming off in the Permian Basin and the oily basins, the gas side is a whole different area. The gas side is poised for growth. We have three super trends going on in terms of natural gas. We have massive amount of LNG being built up in order to supply our allies around the world that need energy and need lower cost of energy. We see the AI data center. The power generation needed to drive that is going to be massive. And then thirdly, we got the onshoring of manufacturing that's going to require more energy and a lot of natural gas, a lot of power generation. So across those three super trends, I think everybody on the gas side can be very bullish and poised for growth. And that's, I think, where the companies are positioning themselves.
Got it. So, I mean, coming on the clean energy side of things, so what's the one macroeconomic or policy shift that could actually derail that, the clean energy capital cycle over the next 18 months, in your view?
Well, look, we had a derailing with the current administration, right? And candidly, I wouldn't call it necessarily a derailing. I think people still are focused on decarbonization, but in a smart way. And I think there's a debate in this administration, and maybe not so much a debate. Should it be done through capitalism or should it be done through incentives? And we can have that open debate. And there are still incentives out there. There's a massive amount of capital being spent now to meet some of these deadlines that have to be capital's got to be employed quickly in order to qualify for these tax credits. And there's other parts of the energy ecosystem that this administration wants to support, whether it be carbon capture or biofuels and some other things. So I think that the things that can derail it, we've talked about interest rates. High interest rates is not good for these big, large projects, right? So fortunately, this administration is accommodative in trying to push interest rates down, which will be very positive for some of these large projects that are being built. And Kevin earlier from P66 talked about the projects they're undergoing in some of the biofuels, and that'll be important. Tariff policy and the volatility around that is important because that's going to drive inflationary pressure. Inflationary pressures are not good for clean tech and for the projects that need to be developed. So I think there's and then thirdly, we need to figure out, candidly, where these tax incentives are, where domestic content's going to be, tax transferability, tax credit transferability, things like this need to be clarified. And depending upon how it's clarified, can either enhance clean tech projects or derail some clean tech projects.
Fair point. And I mean, being from the Bay Area, it is definitely fascinating for me how the stance on clean energy and policy changes when profits are being pursued in that sense, right? So, I mean, enough of the macro, coming on to positioning in this uncertain environment from a portfolio perspective. Kara, let me start with you. Are we in a stock picker's market, and how are you positioning in this all this uncertainty and all these picks and pans?
So it's funny because I started my career as like a fundamental stock picker, and I think largely like those days are kind of over, right? The idea of coming up with your earnings model and trying to figure out who's going to beat. And if you look at the data, I mean, over the last 10, 15 years, it's been extraordinarily hard for a true stock picker to be able to outperform the benchmark. Now, there are ways that I think you can solve for that by driving down costs, by actually taking alpha. But to the point of whether or not we're like shifting to an environment where we get back to a stock picker's market, I think it's potential. We've had an extraordinarily concentrated market over the last 3 years. So the bogey has been very, very high with the Mag 7 kind of dominating everything. And so as we think about putting portfolios together, it's, yes, like, are there ways that we can capture alpha through individual security selection? Are there other factors that we can identify where we think we get an edge? Moving down cap, moving into other types of factors or sectors. And we think that there are opportunities there. So it's sort of like using your full toolkit to be able to find sources of alpha and not necessarily just getting back to that, ooh, you know, this company's going to beat versus
Absolutely.
another one.
No, and I'm with you on that. So before we get in deeper into the positioning element of it, the one theme that we've seen come across the future investor panels across the year, be it SF, Atlanta, LA, was the US exceptionalism. And before we actually delve deeper into that, and I have some very interesting pre-conversations that I've had around that, again, guys, let's ask you all. Quick raise of hands if you think US markets will continue to outperform international markets in the next year, in 2026. Well, there we go. So if you had that view at the start of the year, you must have done well, and I'm your closest friend. But Eric, let's unpack. What is driving this exceptionalism, and what can get the US market to keep going? And what are the factors that you're considering around that?
The biggest drivers that we see behind American exceptionalism would be accounting standards, shareholder friendliness, rule of law, things that are maybe a bit more boring to talk about, but in fact are the hallmarks of I think the U.S. public equity market. Everyone on this stage has been in meetings. I remember sitting in Beijing in a room with a project that I thought had no chance of failing, and yet the rule of law concerns that we had suggested we should remain on the sidelines, and I'm glad that we did. So we can't dart past those underpinnings. I do think that the American exceptionalism, in terms of, and Kara nailed it earlier, that idea of a very narrow market, I think that AI has to go through a three-phase process in terms of our assessment as investors. Phase one we've already gone through, which is...
No, I'm not going to let you spit into AI just yet.
No. Well, but I think that the idea that, for U.S. companies to continue to do well, we have to remain in this phase, which is between, basically this notion that hyperscalers and the supply side of AI have basically a blank check to do what they want. And as long as that continues, then I think it's hard for the rest of the world to really materially outperform.
Absolutely.
But we do think we'll get to that other side, which I'm sure we'll touch on. So maybe some
I didn't mean to interrupt.
No, listen.
My every panel conversation just goes into AI, really, just right at the beginning, and we'll get there.
Yes.
But I completely agree, right? Like the whole innovation capital that the U.S. is building, there is a lot of tailwinds that provides to markets. And the big keep getting bigger in that sense. So 100% agree with you on that. Kara, you had your skepticism around this, right? What is worrying you? And how do you position if there are people who want to find alternatives? Like, if not the US, then where?
So I think it's very interesting, and it felt like 50-50. We're like thinking U.S. would outperform versus non-U.S. And my guess is that that number is more balanced than what it would have been in the beginning of the year. And I say that just because I spend a lot of my day talking with individual investors, and many of whom were saying for many years, why do I own anything outside the U.S.? And there was really good reason, because for 15 years, the U.S. market, S&P 500 in particular, outperformed everything else. So it was really hard to kind of make that argument that you should own something outside. But then lo and behold, first half of this year, you have dollar down 10%. You have emerging markets that are up, 27, 28% so far this year. Most people have very small exposure to emerging markets. Meanwhile, it's the best performing asset class. So yes, the U.S., I think, is still very much the center of innovation, all those reasons that you mentioned earlier. But all you need to have is sort of a narrowing of those expectations between the U.S. and the rest of the world in order to see the rest of the world outperform. And at some point, those valuation differentials reflect the better position of U.S. markets.
So even a little delta
even
can
a little
move
bit.
The flows a lot, right?
100%. And we have had long periods of time when U.S. dollar has underperformed and non-U.S. markets have outperformed. And it wasn't that long ago.
Absolutely. Eric, you also liked some global opportunities, right? What do you like between the EM-DM conversation or even within the EM space that we were talking about?
Yeah, we think it's probably an industry construct that should go away, the EM-DM distinction, just because let's call it the disparities across countries are so great. You think about China versus Brazil versus India versus Indonesia. These are entirely different entities. Yes, there's one commonality. They're not dollar denominated, but even in some of those cases, they're quasi-dollar pegged. So.
And the tariff conversations have completely changed the argument, right? Like,
I'd say that we were a bit underwhelmed coming out of the press briefing from Air Force One, not a political statement, but just like what was truly resolved from a tariff standpoint. Not really much. It was really more of a delay of what may come in future months or years. So, things that we like. So global infrastructure is a spot where we think that as this world becomes more challenge and as it becomes a bit more, let's call it territorial and less collaborative, getting content in hydrocarbons and petrochemicals from point A to point B is more difficult. And we like the idea of having some cash flow affixed to those assets, but also some embedded inflation hedges. Those are things that we like. We also think that healthcare, which has been a very underloved sector, is a spot that we think obviously has long-term tailwinds behind it. We're all getting older. We're all enjoying healthier, longer lives. That being said, that has to be funded in some way, shape, or form. So those are some areas that we think have some cross-border opportunities that are interesting.
Got it. And Stephen, how does energy transition kind of play in that space? How are investors positioning their portfolios around that mix?
Well, look, I think in today's world, we're still, I think 2024, we invest about $2 trillion in clean tech broadly. This year we'll probably be up about 10%, about $2.2 billion. So clean tech is still here, notwithstanding some of the pendulum shifts. But I think that money is shifting from a lot of new startups to more mature, larger scale, cash flowing businesses. So the larger renewables, more mature renewables, battery storage businesses that are capital intensive, infrastructure projects as we talked about. So I think instead of people throwing money at new science, there's been a lot of money lost actually by doing that. And so today I think people are focused on generating real returns in their clean tech investments, and those are pushing people to more mature businesses.
Absolutely. So again, let's take a pulse of the room. How many of you think that the next big unlock or delta will come from energy or industrials rather than tech? Raise of hands for energy and industrials. Oh, we have all tech supporters.
Not even you, huh?
I'm going to push as hard as I can. But
That's when rubber hits the road, guys. Okay, I think we have to get to your AI topic, Eric. I'm sorry. I think, yeah.
Let's do it. Let's do it.
Just one last portfolio part, and then we'll delve right away into that. So, Kara, fixed income is investable again. That's such an amazing,
it's not AI,
right?
but yeah.
I thought that, my children will be in a zone where we'll be constantly living in sub-zero or 0% interest rate environments. How are you thinking about credit and duration and spreads in this context?
So, as you suggested, the good news is that interest rates are much higher than they have been for a good portion of all of our careers. So there's actually some yield to be had. That said, when we look at some areas of the market, particularly high yield, we think that you don't necessarily need to go way out on the credit curve. Similarly, you don't need to go way out the duration curve in order to get that yield. Generally speaking, in other cycles, what we've seen is that as the Fed starts to cut rates, it's actually the belly of the curve that benefits the most. So that's where you can get some higher absolute yields. You benefit from somewhat lower rates in the middle part. And then particularly in things like corporate credit, where you are taking some credit risk, but we think it's very manageable. We think that's a pretty attractive place to be. And yeah, I don't know if you want to talk about private credit, but it's interesting because we've been cautious on high yield for a bit, but certainly more recently, a lot of the headlines about some oopsies, let's call them, in the private credit world I think pointed to some lazy underwriting. I don't think it's necessarily a sign of a great credit cycle coming, but I think what we have seen is that there's been some faster growth in certain areas of the market, and we're starting to see the strains from that.
Yeah, I think the moment credit kind of comes up on the radar, people react first and think later, right? So I completely agree with you on that. Yannick, I tried my best to put the AI discussion till the end, but I'm sorry, I have to, I can't help it. Guys, let's hear from you again. We can't talk about this without AI, so show of hands, how many of you, I think I know the answer, how many of you think we are in an AI bubble? Oh, we do have some people who believe that. That is amazing. Kara, I will let you address the elephant in the room. Are we in an AI bubble? And more importantly, what are the factors that you would consider to answer that question, right?
So I will preface this by saying I started my career in April of 2000, so almost to the day that the NASDAQ peaked. So my first couple of years on Wall Street were sort of learning the hard way the danger of a bubble, particularly a technology-related one. And so when we compare sort of like today's AI trend, let's call it, and compare it to the dot-com bubble, we see some like really significant differences that I think are very important. One is the earnings power and the free cash flow generation of these names. So, the largest names in this space have gotten even larger, but they have done it by actually generating earnings. Now, what we've seen over the last couple of years is that valuations have increasingly diverged a bit from that earnings power, but that earnings has continued to increase. The other thing that I think is very important is that, if you look at the 5 largest AI-related players who are spending CapEx right now, talking on the order of like $350 billion in CapEx by 5 companies alone. I mean, just extraordinary dollars. All that money is finding its way into the real economy. Now, I think it'll be a couple of years at least before we really start to see returns on these AI investments. But for now, all those dollars have to find a home. And by the way, 2026, I predict those numbers are going to be even higher. Yep. So right now, it's just money needing put to work in like real things, data centers, servers, power, and all of that has to find a home.
I guess the question or the challenge, or where my friends are worried about, is what if the market tomorrow starts questioning the ROI on those investments, right? Like how much patience will investors have? And as I said, like nowadays you've seen market response first, things later, right? And then the concept of this whole circular investing, and I'm sure everyone's kind of been following the headlines there. I'm with you guys. It gave me a reminder of the whole GFC situation where all the interlinkages, we completely kind of missed that part of the risk equation, right?
But here's the problem. We've only got really one data center, one mega data center built. We're not even have these built yet.
Yeah.
We can't be in a bubble yet. We don't have the capital deployed.
Yeah.
We got billions and hundreds of billions of dollars that have yet to be deployed into the marketplace, utilizing all sorts of supply chains, all sorts of workforces. We haven't even started to spend that money yet. I mean, very infancy of that. Mm-hmm. We can't be in a bubble yet. We're years away from being in a bubble.
I like that conviction. Eric, are investors really underestimating the productivity impact of AI? How are you kind of thinking about that?
We think there's over-extrapolation. I mean, I'll give a couple of examples. One is that this is not a very well-diffused technology yet. I mean, there is a significant supply constraint that exists. Think about, just go through NVIDIA's last quarter, think about the major supplier, the glut of obviously, I should say, the hope of more chips arriving. This just hasn't been, there's been so much focus on the supply side. The demand side is when we'll know if we're in a bubble. If every company that comes out with a somewhat credible AI plan from a use case standpoint and talks about sustainable returns, and if that premium valuation is just over premium, that's something that says to us we've gone too far. We're not there yet. And so I think that, I'll give you an example. There are some applications, like I was in Ohio 2 weeks ago. We're a large user of AI at US Bank. Built a presentation, a deck using AI, spelled the word Ohio, and said, hey, can you design a slide with these inputs? And we have a very stupid version of AI. It spat out the wrong spelling of Ohio 7 straight times. Now, that's a very low-risk output, right? I could have swapped to PowerPoint if I so chose, not the end of the world. There are other transactions, like financial transactions or medical applications, where there is zero room for error. Money is lost permanently, someone dies. Those are applications that have not yet been fully filtered in. So I do think, if we kind of harken back to things like 3D printing, everyone in this room is supposed to have a 3D printer at their house. How many people in this room have a 3D printer at your house? Raise your hand, please. 2, I believe maybe 1 or 2. And so, look, we're all using it. It's all being used on us, but the applications have not fully diffused yet. That return on invested capital, return on capital employed argument, I think probably happens quicker than late 26. I think there are going to be some companies that are held feet to the fire more quickly than that. That's when we'll know if we're in a bubble. We're not there quite yet, but the test will come. The test never came. I started a year and a half earlier than my colleague to the right. San Francisco, Goldman Sachs printing 3 deals a day. This is very different than where we were at that juncture. So I think that there's still time to tell, but that diffusion is something that is certainly important for us to all assess.
Well, we can do another assessment right in this room. How many of you actually use AI for your day-to-day workflows, for work? So we do have demand. And how about personal stuff? Oh, yeah, for sure. My 12-year-old is writing code in AI, with AI, so I completely buy into that as well. Stephen, you've been watching the deal flow. Where is the one area where capital is flowing quietly and people have not paid attention?
Look, I think we talked about the data center, so let me start it by tying into the data center. We have a huge amount of power generation that needs to be distributed to data centers all across the country, Canada, all across the world, but let's talk our country, all across the country. Our grid has not been upgraded in 30 years, right? So we need substantial amount of capital deployed to the grid. And what I think we're going to see that is in smart grids. We need to be able to really deploy the capital into making our grid smarter, much more efficient, much more resilient, and much more dynamic. And so things, sensors, AI, sensors, meters, I think these are all areas, anything to do with the grid on grid efficiency, utility services is going to be another big area. You see that going on now. Anybody who touches utility services, whether it be in the clean tech area or even in the much more developed areas, are growing at rapid paces. Their share prices, if they're public, are exploding. So these are areas that are clearly going to happen. I think the other thing we need to do is, while we need a lot more energy from all sources, hydrocarbon and renewables, et cetera, we also need to be able to use our energy much more efficiently. So anything in the energy efficiency area, I think, is starting to really catch on. People are developing new technologies in a way to make energy more efficient and be able to conserve more of what we have rather than use it in less efficient ways. So I think those are 2 key areas that I think people are really starting to identify investment opportunities and starting to put a lot of money toward.
That all makes so much sense. So, and what is interesting is when you see correlations between energy, industrials, and tech, that kind of tells you another story, right? Interestingly, we are at time. Ladies and gentlemen, thank you. So the one thing that I would love for you to take away from this panel is the next cycle of returns is not going to come from doing more of the same thing. And that's the one takeaway that at least I had from our conversations. So we need investors need to be more curious, flexible, and forward-looking. And the U.S. exceptionalism play, we cannot take it for granted. So let's keep our eyes and ears open and charge along. Thank you so much. You've been a lovely audience. Thanks a lot for spending your evening with us.
Yeah.
Thank you.
That's a great way to conclude this event. Maybe not so much, but this concludes our content portion of the event tonight. And I'd like to thank our speakers. They gave us a lot of information to digest for our audience being so captive, and as well as our sponsor, InvescoQQ. If you want to learn more about them, they're on the event website. You can check out the resource tab. And this event, if you want to revisit everything except that last tripping episode, is recorded on BloombergLive.com. So for you guys on the live stream, it's goodbye for you, and everybody in the room, please join us for some networking and cocktails outside. Thank you. Oh my God.
Come here, buddy.